Hello and welcome to Star USA Training. Today is Tuesday, September 9th, and we're talking about USMCA and locking the benefits of free trade agreements. Whether you're joining us live or watching the recording back, we appreciate you being here. If you are attending live, we encourage you to introduce yourself in the chat. I see a lot of people are already doing so. Let us know where you're joining from today. We'd also invite you to connect with Star USA on LinkedIn. We're focusing on growing our presence there this year by sharing valuable content, including industry insights, updates, articles, and training opportunities. We would love to connect with you, and if you're comfortable, feel free to drop your LinkedIn profile in the chat as well so we can continue the conversation beyond today's session. This session is being recorded. After the webinar, we will upload the recording, slides, and any additional materials to our website. If you are registered for the webinar, you will receive an email with the link once all those resources become available, usually later in the week. Give us a few days to get all that stuff up there. For those seeking continuing education credits, we will provide a CE code at the end of the webinar. The session today qualifies for one CE credit for licensed customs brokers and those with CCS credentials from NCBFAA. Please be sure to save the code given at the end of the session. If you are watching this back on YouTube later or watching the recording back, there will be a different code for the recorded version. So if you're watching live, make sure you get the live code from the last slide. We do encourage you to stay engaged throughout today's session. If you have questions, please drop them in the Q&A at any time. The chat usually goes by too fast for me to monitor, so if you can get your questions into the Q&A box on the webinar thing, that would be great. We do have time set aside, hopefully. We'll see how the content goes to address your questions at the end and help you navigate any challenges you're facing. But if you have questions that you want to get answered that you can't get to on the webinar, please feel free to send us an email at train@starusa.org. And then lastly, a quick disclaimer. I am a licensed customs broker, but today's discussion is informational only and should not be considered legal advice, nor the transaction of customs business on your behalf. If you or your company need additional assistance after the webinar, please don't hesitate to reach out. And with that, let's get started on USMCA. Real quick, my name is Mike Easton. I am the president and general manager of Star USA. I've been in the industry for more than 20 years. I've had my broker's license for more than 10 years. I'm a huge trade compliance nerd, so I get pretty deep in the weeds on a lot of things, but I am not a master of all things at all times. So a lot of my expertise comes from knowing where to find information and knowing who to talk to get the right answers. So if I don't have an answer to your question today, please bear in mind that I can still help you find an answer to your question, even if I don't know it off the top of my head. Star USA has been in business since '96. We're coming up on a 30-year anniversary next year. If you'd like to learn more about us, you can visit us on the web at starusa.org. We do a lot of in and outsourced support for our clients. We help them navigate all manner of international trade and compliance needs, and we get in the weeds with a lot of our clients and help solve some of the problems that come up. And this year there have been problems. So if you'd like to reach out to us afterwards, please feel free to do so. Okay, we're going to hit from the top just some of the basic primers of what USMCA and other free trade agreements are and what they are not and how they kind of work. One of the key things to keep in mind is that free trade agreements are at their core a duty preference program. The landscape of trade agreements has changed and shifted this year, but still, trade agreements are meant to reduce or eliminate duties on and tariffs on goods. FTAs are never a legal requirement. You are not mandated to participate in a free trade agreement. They are voluntary. If you do choose to participate, those come with expectations and penalties for noncompliance. But again, it's a voluntary program. So if you're going to participate, then you have to do so in the right way. And that's what we're going to be talking about today, is how to do that in the right way to some extent. Another thing to keep in mind, this is trade compliance. This is regulatory in nature. Records are everything. Keep your records. If you don't have records, then there is a presumption of noncompliance. And during an investigation or an audit or an inquiry from customs, whether it's a U.S. customs agency or a customs agency abroad under the free trade agreement provisions, and you cannot produce records, then you will likely be found to be in noncompliance and have your privileges revoked and be facing penalties and back duties. USMCA and free trade agreements generally, they affect duties and fees. When we talk about duties, we're talking about the tariffs, those tariff rates that are in the news every day, those rates of duty applied to goods by HS classification at the time of import. USMCA will reduce or lower those duties. And we're also talking about fees. In the US, we're talking about the merchandise processing fee, the MPF. In Mexico, we would be talking about the DTA fee. Canada does not have an equivalent fee, to my knowledge. Free trade agreements do not affect taxes. So GST in Canada and VAT in Mexico and around the world, those things are not impacted by trade agreements generally. Taxes are a separate matter entirely. There are multilateral enforcement provisions giving other foreign customs agencies the right to investigate U.S. companies participating in these trade agreements. They have the right to send inquiries, and they can trigger even a customs audit by going through the proper channels to get U.S. Customs to visit your facilities or to evaluate your trade agreement practices. But you can receive inquiries from foreign customs agencies under the free trade agreement provisions. So there are three primary motivations for using trade agreements. The first one is that you want to pay less duty on your imports. That's the most straightforward and direct path. You are importing something from a country that we have a free trade agreement with, and you want to pay less duty on it. So you want to evaluate getting that preferential duty on that import. The second motivation is that your customers are in a member country. So your customers are in Canada or Mexico, and they want to pay less duty on their imports. You're shipping to them, and they want the benefit of the trade agreement, so they need documentation from you as the U.S. seller. And then the last scenario is your customers in the US have exports to a member country. So you're selling to someone domestically here in the US, and that party is exporting the goods to Canada or Mexico or to another free trade agreement country. And that customer in that foreign country wants to pay less duty on those imports. One of the key uh, through lines here is that the duty savings is applied at the time of import. There are not duties on US exports. So you're not saving duty on the export side, you're saving it on the import side. And therefore, free trade agreements are a claim made by the importer at the time of importation to receive that preferential duty, that reduced or free rate of duty. It's important to note that FTAs do more than just reduce duties and fees between the member countries. There are more things at play, things like foreign trade policy and federal relationships and the way certain industries are given certain benefits. We're not going to get into all of the different details. Every trade agreement has their own kind of mission to promote commerce and trade and things like that. But the manifestation of those things is usually through that reduced rate of duty. When we go through material today, you're not going to be suddenly a master of FTAs. That's not the way that this world works. But we are intending to give you some tips on how to move through and work with the concept of trade agreements through these motivations and understand when you're which person and where to go to get resources to help you navigate these things. Again, if you as you have questions, if you get stuck, please feel free to ask in the webinar question and answer tool thing. Some key things to remember. Trade, international relations, and foreign policy are in an unprecedented state of disarray right now around the world. This is a very unique circumstance here in 2025 that I've not seen in my 20 years, and I don't think many people working in the industry today can even relate to. So anything that's going on in the world today is going to be met with a lot of uncertainty from everyone in the industry. Anybody that's telling you that they are certain what's going to happen, let me know who they are because I would love to talk to them. But there's a lot of stuff going on, and we need to be very careful about how we're interpreting the new information that's coming out of the U.S. administration and from other governments as new trade agreements are negotiated. But are they actually the free trade agreements that we're used to? And how do they work? And when do they apply? And what do they apply to? And all of those different questions, they're not quite as simple, or at least not as direct as they once were. And we need to take that into account as we think about embarking on participating in these agreements. But currently, the US has 14 free trade agreements in place with 20 countries. There is an agreement in place with Japan for minerals. It's not really a trade agreement, but it's got some of the hallmarks of, but it's not a full-blown trade agreement. And the US and EU have reached an agreement to establish reduced rates of duty on the IEEPA and 232 tariffs. That agreement and the text of it is very much a commitment to make a commitment. It's not what I would consider to be a free trade agreement by the normal definitions that we were used to before 2025. So there's a lot of uncertainty and new ground that is being walked right now that needs to be met with a bit of skepticism and hesitancy before anything actually is different. We're all trying to navigate it together. So I understand the challenges and frustrations that people are dealing with, and trust me, I'm there with you. Over on the right side, we have our list of the 20 countries. We have 12 that are a bilateral agreement. It's US Australia, US Bahrain, US Chile, and so forth. That's between those two countries. No other countries are party to any of those agreements. But then we have the multilateral agreements, DR-CAFTA and USMCA. Multilateral means that all of those countries are part of the same agreement. So in DR-CAFTA, there are 6 countries plus the US that are participating in the program. In USMCA, there are 2 countries plus the US that are participating. And all of those countries within the multilateral are beholden to the same rules. It's important to note that each trade agreement has its own standards, its own rules of origin, its own expectations on what originating means under that trade agreement. There is no uniform definition across all FTAs. You can have a good that you're importing from Canada that qualifies for USMCA. You can use that good in production here in the US and then ship it to Korea. That doesn't make it eligible automatically for the US-Korea trade agreement because you have components from a country that is not party to that US-Korea trade agreement. Same thing in reverse. You can import goods from Morocco that are subject to the Moroccan Free Trade Agreement and use those goods in production and then ship them to Canada or Mexico, and they would not automatically be eligible for USMCA. Doesn't mean they cannot be eligible for USMCA. It's just not automatic. There has to be a rule of origin that is met in each of those cases. So you cannot infer compliance with one agreement just because they comply with another agreement. And then our last bit on the tariffs under the International Emergency Economic Powers Act, or otherwise known as IEEPA. In the current state of affairs, as of today, Tuesday, the U.S. Court of International Trade on May 28th held that the reciprocal and trafficking tariffs under IEEPA exceeded the presidential authority. On August 29th, a couple weeks ago, the U.S. Court of Appeals upheld that CIT decision. And that decision from the Court of Appeals and the Court of International Trade is being appealed to the Supreme Court. And the administration has requested to hear back by tomorrow. If I could have changed the date of the webinar to wait until we knew more information on the IEEPA stuff, I would have included that information. Unfortunately, we are in a waiting game, and we don't know if it will be tomorrow. We don't know if it'll be today. We don't know if we're going to hear back months from now. But that's kind of the current state under IEEPA with reciprocal and the trafficking tariffs, the fentanyl tariffs that were announced earlier this year. Should be noted that goods qualifying under USMCA specifically are accepted from the IEEPA tariffs, but not the Section 232 tariffs, the aluminum, steel, and copper, not necessarily. And goods from FTAs or goods subject to FTAs other than USMCA would not be impacting the IEEPA or Section 232 tariffs. There are separate trade deals being negotiated and rolled out on a one-by-one that will modulate the IEEPA and 232 impacts. There's been talks with UK and with EU and with Vietnam and with Korea and several other countries. And to my knowledge, none of them are particularly definitive or far-reaching. They're only in scope of the IEEPA and potentially the Section 232. So paying attention to each one of those spot agreements as they come out and what their dates of effect are and how those are implemented are going to be case by case. So there's no universal one-size-fits-all rule for any of those. So that's kind of the current state as I understand it. But there are a lot of nuances, and it's a very complex topic that we will not be going into today. Instead, today, we're going to focus on the 3 common scenarios for using free trade agreements. And that's when you're the importer, or you're the exporter, or you're the producer. Those are the 3 most common times where you're going to be responsible for knowing how to comply with a free trade agreement. We're going to talk about the basic steps for each of those scenarios, and we're going to talk about troubleshooting, navigating, and some of the tips and tricks to sustain those within your organization or to perform those responsibilities as one of those roles. And again, we'll have time for Q&A at the end. A lot of the answers to a lot of the questions that we get on FTAs are some version of sometimes or some version of it depends, and you have to check a lot of different facts and factors. So I'm speaking in broad terms about FTAs here, and then as we go into the content, I'm going to be focusing from the perspective of USMCA specifically. I'm not going to be trying to layer in a bunch of different considerations for the 14 different trade agreements that we have. So just please recognize that each agreement has their own set of rules and their own set of way of interpreting those rules. I'm going to be using USMCA as the frame of reference since it is the most common for our audience. It is the most prevalent here in the US, and I get tripped up a lot if I try to account for all the different FTAs that there are. So I'm trying to keep myself from code switching too much into a bunch of different trade agreements. So we're talking about USMCA. So the common scenario one is you are the importer. You have suppliers in Canada, in Mexico, and you are the importer of record bringing the goods into the US. And here are the two easiest ways to comply. First, you request a certification of origin from the supplier. They provide it to you, and then you verify its validity, and then you notify your customs entry broker prior to import. That is the most straightforward way as an importer that you would comply with USMCA. You've asked your supplier for their cert. You've checked to make sure that it's legit. You've done your due diligence to make sure it's valid. The scope of that can vary, but the rule here is know your goods and know what the certification is supposed to say. And then you tell your customs broker, hey, broker, I have a cert on file for these goods coming from the supplier. Please enter these duty-free under USMCA. And if your broker needs additional documentation or evidence, they will request that. It is much more common this year than it has been in past years to request for the brokers to request documentation, just because there is a lot more swing in the potential usage of USMCA. Huge uptick means a lot more bad certs being out there in the wild and much more due diligence required. However, it's never quite that simple. When you ask for your certs, problems will arise. And let's talk about some of those problems that we're going to face. The first one is the supplier doesn't understand your request. It's very common. It was more common in years past, but the supplier will say, what do you mean USMCA certificate of origin? I told you it's Canadian origin. I told you it's Mexican origin. Isn't that enough? The second common scenario is that the supplier certificate is unacceptable. This is where the validity comes in. And we'll talk about some of the ways to examine that and understand what valid means. And then the third option, or one of the third common problems that we face, is that the USMCA wasn't claimed before the entry got filed. You got the cert too late, you found out after the fact, the goods came in, you paid duty, now what do you do? So let's take these each in turn. For the first scenario, where your supplier doesn't understand the request, your first set of responsibilities is to educate the supplier. Explain to them what USMCA is and why it's important for you to have that certification and why it needs to look a certain way. Point them to resources in their own country. Canada has their own CUSMA website. The USMCA is known by CUSMA in Canada and it's known by TMAC in Mexico. And they have websites available for companies to be able to navigate those things. Inform your supplier that it's important for your business. This is where the resources are, and help them understand why you're trying to get this certification. And then also direct them to inquire with their customs broker or their freight forwarder or another resource that they can access in country to help them make their determinations. As the importer, you generally should not be claiming USMCA without thorough knowledge of how the goods are produced and that they are going to be, in fact, eligible for USMCA. The easiest way to have that evidence that you need, that you know that the goods are eligible, is to get the certification. If your supplier cannot provide you with a certification, something else is probably wrong. There must be some reason why they cannot do that, and that reason might be that the goods are not, in fact, eligible for USMCA. So you need to know why you can't get those certs. The piece of paper is the most common and prevalent way. There are plenty of exceptions where the importer can make a claim based on their knowledge, but you need to be at a higher level of diligence than just obtaining a piece of paper. You need to have full knowledge of the entire production chain and the sourcing for those goods. So it's common for suppliers, again, to push back or to decline to provide you the certifications that you need. The best way to combat that is with education. The second scenario is a supplier certificate is unacceptable for some reason or other. The way to navigate this is to identify the concern and work towards a resolution. You'll see a pretty common thread when dealing with USMCAs or any trade agreements of working with your partners in the supply chain. These are not independent endeavors. You need to be able to connect with your suppliers. You need to be able to connect with your customs brokers. You need to be able to connect with your customers. You need to be able to connect with customs. So there's a lot of different layers of having good communication and accountability built into your entire supply chain on the trade compliance side that requires you to have good communication and good collaboration with those partners. When your supplier certificate is unacceptable, the first place that I check is Annex 5A of the USMCA agreement, which spells out all of the data elements that are required for a proper certification. Sometimes a certificate from a supplier will be invalid because they left off one of those key pieces of information. Simply ask them to provide it and let them know why you're asking for them to provide it, and then work with them to make sure that you get a valid cert that way. Sometimes you'll have conflicting information. They will tell you that the HS number is different than what you expected it to be, or it might conflict with their commercial invoice. The certification that they give you for USMCA has a different HS than their commercial invoice, or a different product description, or some other factor like that. Those are things that need to be communicated about. Why is this different from the other documents, or why is this different than we expect? We understand the HS classification to be this classification. You've put this classification. How do we resolve this conflict? So you have to communicate. And then lastly, if you suspect there's a false claim being made, again, more prevalent this year than in years past, but your obligation, if you suspect a false claim is being made, is to either confirm the suspicion and inform the supplier and CBP as appropriate, and then don't file a claim if you cannot validate that it's accurate. Suspicions of false claims can arise from a lot of different sources. One of the ones that I'm seeing and hearing about more commonly is importers in the US will know that their suppliers in Mexico and Canada are purchasing goods from China and then just shipping them to the US and claiming Mexico or Canada as the country of origin and claiming USMCA eligibility, even though the goods are definitely not coming from China. There's also an issue with the Uyghur Forced Labor Act and the textiles and certain materials coming out of the Xinjiang region of China that incentivize a lot of the suppliers to fabricate or alter the countries of origin on their goods in order to get them past U.S. customs. Note that customs is ramping up their enforcement measures for all of these factors. They are certainly aware that people are trying to cheat, and the question is, what is going to be the ramification for your business? If you are on record as having knowingly made false claims, you're facing significant penalties in both civil and potentially criminal penalties, depending on the nature of the discrepancy. So you have a responsibility to make sure that what you're claiming is accurate. Remember, as an importer in this scenario, you're the one ultimately responsible for the claims being made on the entry. If you're basing it on information that you suspected to be false, you're going to be found liable for those claims. At the same time, if you have done your diligence and you can demonstrate the steps that you took to ensure that you were compliant, and the goods turned out, in fact, to not be eligible for USMCA, but it was through an honest mistake or a clear error, you have some mitigation available to you there. There's things like prior disclosures that can protect you from penalty. So you might still have to pay the back duties, but you'll be protected from a penalty action. So it's important to be aware and communicate with your suppliers on getting the information that you want. I see too many importers that will just accept whatever piece of paper and think it's good enough. They won't do the diligence to check for the data elements from 5A. and they won't resolve conflicts in things like HS classification or product description, or the signer is not working for the company. And that's a weird thing to have happen. If the exporter is the one responsible for providing that cert, but a different company has signed it, that's a red flag. So you have to pay attention to those data elements and understand why they're on there. And there's a lot of different ways we can talk about the origin criteria and all that stuff, but I'm going to leave that for questions if there are any. And the last concern that we would typically find is that the USMCA wasn't claimed before the entry was filed. One of the ways that you can check that is to use your ACE reports. The automated commercial environment is a window for US importers to pull reports on their import activity. It's pulling data directly out of CBP's system, so it's what customs has on your import activity. And you can check these special indicators, the free trade agreements that were claimed on all of those imports through the ACE ES20. No, I can't remember the number. It's 203, I think. One of the reports that's not springing to mind right now will tell you what the special indicator is for each of the lines on all of your entries going back at least 5 years, if not further. So you can check and see which claims were made. You can see how much duty was paid, and you can identify if there were any issues with those claims. Either you claimed when USMCA when you were not supposed to, or you did not claim USMCA when you were supposed to. So you want to identify and correct any of those errors that you discover from those ACE reports at the same time as you're claiming back duty. But you can request a refund. The agreement allows for claims to be filed up to 1 year after importation. So the actual text of the USMCA, the US Mexico Canada agreement, says that you get 1 year of grace period after the date of importation to file an amended claim, basically, and recover any duties that you should not have paid. And it is codified into the agreement. All three countries have agreed to this 1 year recovery period. Beyond that 1 year period, your recovery opportunities are fewer and further between, and you may not be able to recover stuff beyond that point, but you do get a year to correct any times where you did not claim USMCA and you should have. And that's a fairly common practice. You should have a pretty routine practice in place where you're evaluating your entries to make sure that you have properly claimed all the duty preference that you were supposed to, and that you're filing regular updates with customs to get those monies back. And if you don't have it as part of your regular audit program, then you should consider starting it. That's one of the biggest reasons to incentivize businesses to evaluate their entries. Along the way, find those other areas or other errors that may have cropped up in your entries, but also recover the amount of money that you should have been paid because the goods were eligible. And then once you find those errors, you can contact your broker, provide them whatever necessary documents they have, and ask them to file a 520D. It's what it's called. It's 19 USC 1520D is the provision, and those claims are called 520Ds. Obviously, the best version is that all claims are made properly at the time of import, but if you don't have the certain time, which is very, very common, especially for early parts of the year, then have a program in place to identify those entries, identify those lines on those entries, and get the proper documents and notify your broker. I know I'm making it sound simple, and it is in words, but in practice, it's much more difficult. The second common scenario is you are the exporter, and specifically, you are not the producer. This scenario is about just being an exporter. So you're a distributor, or you've purchased goods domestically, and you're just shipping them to your customers in Canada or Mexico. And your customer in Canada or Mexico has requested a USMCA, a CUSMA, or a TMEC certification from you. Be aware of the lingo. Each country has their own terminology for this. So if they ask you for a TMEC, they mean this. If they ask you for CUSMA, they mean this. The easiest way to comply is to obtain a supplier certification from your supplier or from the original producer of the goods, and then prepare your exporter certification. So it's very similar to the importer step, except there's not a border crossing. You are still asking your supplier for a certification. To get that supplier certification, that document is given to you by your supplier, traceable back in sequence to the original producer of the good. Sometimes your supplier is the producer, and sometimes your supplier bought it from a different party, and they bought it from a different party, and then they bought it from the producer. So there could be multiple layers in this supply chain, but you want to be able to have the documentation to trace back to the original producer of the good in most most cases. You don't necessarily have to have all that information on file for yourself as the exporter, but your supplier is responsible for having those docs, and they're responsible for giving you their certification. They don't have to tell you who the producer is, but they have a responsibility in the supply chain. So you go to your supplier, you ask them for the USMCA certification, they give you a document, and presumably they can trace it back to their supplier. As the exporter, then, you take that supplier certification and you would create an exporter certification. That exporter certification will be given to your customer abroad. So it'll be given to the importer, and that will complete the certification chain. The importer will then instruct their broker to claim USMCA on the entry, and end of story. Be aware that supplier certification should contain all the same essential data elements in Annex 5A. They are not generally the supplier certifications are generally not used for the export transaction. It is much more common for the exporter to prepare their own certification based off of the information from the supplier certification that contains all the same data elements, but they would prepare their own exporter certification. So once you obtain your supplier certification, you take it and you prepare your exporter cert, and you make sure that all of Annex 5A data elements are captured on that certification. Those 9 data elements are the preparer type. Are you the importer? Are you the exporter? Are you the producer? The certifier's information, your name, title, address, phone, and email. The exporter's information, if known. It is not required if you are a producer of the good, but in this case, you are the exporter, so you should know your own information. The producer's info is the address of the place of production within the territory. The importer's information, if known, and the address of the importer must be an address within the territory here being US, Canada, or Mexico. The description in HS classification to 6 digits. It is appropriate to only provide the first 6 digits of the HS classification. Do not provide the full US HTS. Those are for US imports only. So the exporter would only provide the 6 digits on a USMCA certification. Use the origin criteria from Article 4.2, holy growth, production of goods from various different countries, comply with the rules of origin. We can talk about origin criteria later on, but you would include that on the cert. The blanket period, certifications are good for up to 12 months. You can limit the certifications to a specific shipment if you want to, and still keep the blanket period of 12 months, or you can limit the time frame to only a couple of months. It is common practice for the blanket period to be precisely 12 months, January 1st through December 31st of any given year. Almost everybody in the industry prepares certifications that way, and the blanket period covers that 12-month period. And if you want to limit what you're claiming USMCA on, specify it in the product description and HS classification zone of the certification. So limit it to a specific shipment, or limit it to a specific category of products that are produced for this specific customer, or name the importer specifically on the certification so that only goods imported by that importer are covered by this certification. There's different ways to limit, but typically the blanket period is for 12 months. And then an authorized signature and date, including the legal text from Annex 5A. If it does not have the text that states that I certify that the goods described in this document qualify as originating and the information contained in this document is true and accurate, I assume responsibility for proving such representations and agree to maintain and present upon request or to make available during a verification visit documentation necessary to support this certification. It needs that whole block. I will say I did not memorize that. I do have it written down in front of me, but it needs that block of text on that certification. This is one that people will accidentally leave off, or will be a good red flag of knowing if this is a USMCA certification or if this is just a standard certificate of origin. If it doesn't contain that information, then it is not a valid USMCA certification. So all 9 data elements need to be on there. I know I'm kind of going through these, but I'm trying to leave time and I'm not doing a good job. I'll need to go faster. The last scenario here is the situation where you are the producer. You have actually made the goods, and you and your customer, in this case, are both located in the United States, but your customer's customer is located in Mexico or Canada, and they need a cert for their customer. So you're the producer, and you're just preparing a domestic certification. You're the supplier in this case. How do you navigate that scenario? I will say that this is the most involved. When you are the producer of the good, you have the most steps. And that the big step here is conducting the USMCA qualification. And then once you've done that, then you can provide your certification to your customer in the US. Or if you're also the exporter, then you would provide an exporter certification to your customer abroad. And how do you do that? How do you conduct a USMCA qualification? There are two basic steps that you have to follow. Again, I know that this is very, very complicated. Those of you familiar with the qualification process can see how much simplifying I'm doing here, but bear with me. The two steps that you must do for your USMCA qualification process is first, determine your HS classification. So what is that six-digit classification of your goods? And then you would go to the agreement or to the regulations and find the rule of origin and apply that rule of origin to your good based on your HS classification. If you don't know how to classify your goods, it can be a very involved process. It is way outside the scope of this session here. We do have webinars on it. Definitely seek help to get your goods classified if you're not sure how to do that. You must have a correct classification in order to proceed with USMCA qualification. The rules of origin for your goods are going to be found in either Chapter 4 of the USMCA or in General Note 11 of the HTS-US. Those are your two places to go look for what your rule of origin is. The types of qualification methods tend to conform to one of three basic principles or a combination thereof, but we're going to go through those qualification methods one by one here. The first and often the easiest to comply with are these special rules. Written into each of the agreements, in the USMCA in particular, there are special rules identified within the text, usually starting at the top of certain sections of the USMCA. So some of those examples, Article 4.12 is the de minimis exemption, the de minimis rule. So if certain goods are, certain non-originating goods are used in the production up to a certain amount, 10% in USMCA, those goods can be disregarded and the good will be treated as conforming with USMCA rules and can be originating if the total content of goods can be de minimis out. It's not very, very common to use the de minimis rule for USMCA. And please note that this is no relation to the de minimis rule that was just repealed for US imports. It's a completely different concept. Importing goods and the type of entry used for goods below a certain value threshold, $800 here in the US, that's a different conversation. The de minimis rule within USMCA has its own text. That is not gone. That is still in effect. There are also notes at the start of Chapter 27 and the start of Section 6 and Section 7 and Section 11. Sections 6 and 7 are the chemical rules. There are certain rules that can be applied to goods that are classified within those chapters that will allow you to qualify for USMCA without referring to the specific rule for that HS classification. So you can actually save yourself some time by meeting one of those rules and not having to qualify for the product specific rule. And then there's also special rules for automotive and things like that that need to be paid attention to. 50 to 63 are textiles and things like that. There's a lot of examples to draw from there. I'm not going to go into all the special rules, but if your good does qualify for a special rule, typically that means your good qualifies. You don't have to proceed beyond that special rule to see if your goods are going to qualify for the product specific rule by HS classification. But special rules are not in effect for all classifications, so very commonly we'll have to deal with either tariff shift or regional value content. The first one we're going to look at is tariff shift. And in simple terms, tariff shift is the transition from one article in the HTS to another article in the HTS. Basically, you're saying these goods have been these goods are sufficiently different from their non-originating components that the entire good should be considered originating. Examples of tariff shift are chapter heading or subheading level, and here's 7201, the rule of origin for goods of heading 7201 is a change to heading 7201 from any other chapter. That's a chapter shift rule. For heading 1704, the rule is a change to heading 1704 from any other heading. That's a heading shift rule. For 320650, it is a change to subheading 320650 from any other subheading. That's a subheading shift rule. So when looking at a tariff shift based rule, and those are the rules pulled directly out of the agreement, What you need to know is if any of your components in producing that good are classified within that chapter or heading or subheading, and if they do not shift out of that heading, then they are said to have not met the shift. So if you have, for heading 7201, if you have inputs, components that are classified in Chapter 38 and goods that are classified in Chapter 50 and goods that are classified in Chapter 72, then you meet the shift for the goods from 38 and you meet the shift for the goods from Chapter 50, but you do not meet the shift for goods from Chapter 72. So if any of the non-originating components do not meet the shift, then your good does not qualify for USMCA. If all of your non-originating components do meet the shift, then your good does qualify for USMCA. I'm going to say that one more time, just to try and be clear about that. If all of your non, no, no, I'm going to start over. If any of your non-originating components do not meet the shift, then the good is not USMCA originating. If all of your non-originating components do meet the shift, then the good is originating under USMCA. Hopefully that made sense the second time I said it, or the first, either one. And if I stumbled, feel free to correct me or ask me questions in the chat here. Okay, the third type of rule or qualification method that we'll be facing is regional value content. Regional value content is a comparison calculation of the value of originating material against the value of non-originating material. There are two basic formulas, the transaction value method, which basically subtracts the non-originating material from the transaction value of the merchandise and divides that into the transaction value of the merchandise, which gives you a percentage. Basically, your percentage of originating material is the result of that. So if you the same formula applies for the net cost method, except you use net cost, subtracting out your non-originating materials, dividing that into your net cost, resulting in a percentage. Written into the rules, they will say typically the good is originating if there's a regional value content using 60% with the transaction value method or 50% with the net cost method. Different percentage thresholds because you're using different value inputs and different things can count as being part of the transaction value versus what counts as being part of the net cost. You have to pay attention to the rules higher up in Article 4 about what is to be considered part of the transaction value or what is to be considered part of the net cost so that you can do your value calculations correctly. But you can include in transaction value, you can include stuff like profit in your calculations, and that's why the percentage threshold is higher typically for transaction value. So that's why you're trying to reach 60% for transaction value. However, with net cost, you would count your labor and overhead and your originating component cost and all that stuff, and you would have a lower threshold to hit because you're not calculating for profit and things like that. The agreement will spell out what can and can't be used for valuation for these calculation purposes. But these formulas will result in the value of originating materials as a percentage. Put in simple terms, regional value content is calculating whether or not there is enough originating content in the good to qualify as originating for USMCA. Have you put enough value in? Within the USMCA, keep in mind your rule is either going to be a special rule or a tariff shift or a regional value content. They don't typically overlap that in such a way that if you do your RVC for all of your goods, that all your goods are going to qualify. A lot of your goods, regardless of value, if they don't meet the tariff shift, they're not going to qualify. So you can't just pick and choose which rule you use. You have to refer to the HS classification of your good in the product-specific rule of origin. Qualification can be a pretty complicated process, and I know I glossed over there. It's for the interest of time. But if anybody has detailed questions that they would like to get a little bit more clarification on how to do RVC qualification, we can talk about bills of materials, cost of bills of materials, and how to look at HS classification and see tariff shift in action. It's just going to be outside the scope of today's session. So once you have done your qualification, your next step is to provide a producer certification to your customer. Again, these are going to conform with Annex 5A, and they should be in line with all of those things. And then as the producer, you should let your customer know that they're responsible for providing the exporter certification. Producer certifications are the first link in that certification chain that completes at the time that a good is claimed at the importation. So all of the parties to the supply chain, beginning with the producer and ending with the importer, are responsible for keeping that chain intact. If any link in that chain does not perform their responsibilities, the end result is that the goods may not be eligible for USMCA, and the importer is going to bear the brunt of that responsibility. There are other scenarios, for example, where you are the producer and the exporter. That's not uncommon at all. You would just do both of the roles that we talked about. You would do the qualification steps as the producer, and you would prepare the exporter certification. Sometimes you are the producer, exporter, and importer, or people tell me that. But realistically, you cannot be all three at once. Sometimes there are related companies involved and there are shared responsibilities. But typically, you're going to need to prepare an exporter or producer certification and give that to the importer for them to claim the USMCA. You still need to make that certification, even if all of your parties are related. You would treat them as separate. And then sometimes you are not the producer, exporter, or importer, and you're being asked for USMCA. The rule here is you probably should not be completing any FTA certifications or performing the qualification if you are neither the producer nor the exporter nor the importer. What you should do there is consult with the experts to understand what you need and why you need it, or whether or not you actually need it. And I'm sure there are dozens of other real-world scenarios, but in the interest of time, we're going to move through. The last point I want to make clear to everyone here is that the word originating, and I've used that many, many times during the course of this conversation, the word originating is different than country of origin. USMCA originating is not the same as origin US, and neither one of those are the same as made in USA. All three of those are different standards. Originating goods satisfy the requirements of that free trade agreement. For USMCA, that means they have met all applicable rules of origin from Annex 4B of the agreement. For tariff shift rules, we're saying that all non-originating materials must meet the shift, and while originating materials can ignore the shift entirely. For region of value content rules, the value of non-originating materials must be below the thresholds given, and therefore the value of originating materials must be above the threshold. That good must contain sufficient value from originating materials. All certifiers, importers, exporters, and producers are responsible for demonstrating the originating status of a good through a certification that conforms with Annex 5A. If you cannot demonstrate the status through a certification, you better be prepared to justify yourself to customs and survive an audit and all that stuff. Without a valid certification, all goods are presumed to be non-originating, irrespective of country of origin. Even if your good is US, even if your good says made in USA, that does not make it originating. It might very well be originating, but you need that document chain to be in place to ensure that the goods are actually originating. If you don't have those documents, just because it says made in USA on the product, doesn't mean it's going to be sufficient for USMCA purposes or any other trade agreement. Hopefully I made that clear. And we'll go through questions here in a minute. I want to let everyone know that we are doing an Elevate Summit for women in international trade and business. Star USA is doing planning our first ever mix of learning and community and mentorship set for Friday, November 14th from noon to 5 p.m. at Fatheads Brewery in Middleburg Heights, Ohio. Tickets are $25, and that will get you access to all of the speaking sessions during that time, networking, professional headshots, food and drink tickets, a swag bag, and access to post-event resources. Registration is opening soon. This is kind of like a pre-announcement, but if you are interested, definitely you can email us at train@staryus.org, and we'll make sure that you get an email when that registration page goes up so that you can sign up for that event. We are very excited. The people putting this together are very excited to be there and to make this happen, especially this year of all years. So if you're interested in participating in this Women in International Trade and Business Summit, please let us know. Super excited about this. Okay, so today we discussed motivations for using USMCA. On the right here are some additional resources that you can refer to. We have a page up on our website with some document templates that you could start with for understanding what goes on to a cert. We have some upcoming webinars, and you can access our on-demand webinars, and then there are resources for USMCA and other trade agreements listed here. Here is the code for today's webinar. We are doing a webinar series October through December, one a month in October, November, and December, looking at year-end insights, dealing with 2025 and preparing for 2026. So we'll be having a couple of guest speakers is the intention. If you can make those webinars, please do so. The first one will be on October 14th, and registration is open for that on our website through this link here. And again, when we send out the slides and recording, you'll have access to all of this information and these links. Okay, so I'm gonna leave this page up and I'm going to try and tackle the questions here in the Q&A session. If you put a question into the chat, please try and move it over to the Q&A and I'll get to it. Anybody that needs to bail, we are at 10 till. Please feel free to leave if you've got other things to do. But otherwise, I will stick around and answer as many questions as I can, as best I can. So bear with me. Okay, Anonymous asks, how do you verify the validity of the certification? And this is a nuanced answer. I gave a brief answer earlier about Annex 5A and making sure it conforms there, but you have to also use your knowledge and understanding of the products and how they're being qualified. So you have to apply critical thinking. There isn't a standard one size fits all. If it has a stamp on it, it's good to go. In fact, they don't have stamps. So you have to start with Annex 5A, understand what Annex 5A is looking for, understand what the certification is being used for. Are you the importer? Then you need it to look a certain way. Are you the exporter? Then you need it to prepare it a certain way. Are you the producer? Then you need it to say certain things. So it's start with Annex 5A. Roberto asks, here at the border, you can tell a bad cert when they use A as the criterion for manufactured goods. Absolutely, Roberto, that's a good point. The preference criteria or origin criteria, it was preference criterion under NAFTA. Now it's origin criterion, and it trips me up horribly. Origin criterion A means that the goods are wholly of the country in which they were produced. Wholly of means that you can basically trace it back to the earth. We're talking about minerals that were mined from the ground, not further processed, fish that were caught in the rivers, crops that were grown on the land. That's what we mean by wholly of. If it's not one of those things, then you've got a produced good and you're looking at origin criterion B, probably, possibly C. Origin criterion B, I think the exact wording, this is off the top of my head, so bear with me, is that the goods were produced in the territory from goods that met all applicable rules of origin, and therefore the goods are, the finished good is eligible because it's met all applicable rules of origin. But yes, a preference or origin criterion A is a big red flag on certs. If they put A on there, stop. If it's not an animal or a crop, then or mineral, you're kind of should be suspicious. For a list of currently available ACE reports training resources, visit CBP's ACE Training and Reference Guide. Thank you, George. That is a good reference there. And we will copy that into the chat here momentarily. Yeah, I did that. The ACE training and reference guides are sometimes hit and miss, but it is absolutely the right place to start. And if you need more help, talk to your broker, or you can reach out to us. We do a lot with ACE reports. Thank you, George. Miranda asks, if the classifications don't match and there's a disagreement on the HTS from the supplier, how would that be handled? Does that void the cert and you can't claim? There. If there is a disagreement and neither party is willing to admit that the other is correct, as the importer, you're going to declare the classification at the time of entry on the entry, and you're going to claim preferential treatment under the trade agreement. You have to be prepared for navigating the discrepancy if a customs agency calls that certification into question. Your best course of action is to get a definitive answer to what the correct classification is. If you can't reach agreement between you and your supplier, then go to your customs administration. Go through the rulings process here in the US. Canada has something similar. I'm not sure exactly how to do that in Mexico, but you can get a definitive answer, and then you'll have that answer from customs of what the correct classification is. So that's what you declare on your entries, and then you should be in compliance. You should also notify your supplier that, hey, your customs administration has issued a ruling on this product, and this is the correct classification. How do we resolve this going forward on the documents? You should be able to reach an agreement. If you have reason to believe that the supplier is doing the certification invalidly, their practices aren't right, or they're basing the rules on the wrong HS because they want to use an easier rule, they want to do tariff shipped instead of regional value content or whatever, you cannot use a cert that you suspect to be invalid. You would have a legal responsibility and a legal burden in that scenario. Don't you have to flag the entry for reconciliation in order to claim USMCA at a later date? No, you do not need to flag for recon in order to claim USMCA. People in recon can, and there's a USMCA version of recon that allows for that flagging practice. How you do that with USMCA goods is a little bit different. So if you're in the recon program with USMCA goods, your practices are going to be different than if you're in the recon program without USMCA goods, or if you're claiming USMCA after the fact using the 520D process. But recon does complicate everything. Anybody that deals with recon should um, recognize that. Good question. We are running into an issue with the IEEPA tariffs that we did not have a valid USMCA at time of import, but have since obtained, and being told by our broker that they are waiting on CBP guidance from CBP on how to file a protest for those entries. Why would CBP need to provide guidance on this? Are we able to recoup these duties? Is under our understanding that we could. My best advice here is first to say, I'm sorry that this is the reality that you're living in. Also, your brokers are not the ones at fault here. They literally cannot file certain corrections without CBP telling them that it's okay to do so now and how to do so. So your broker is likely stuck in a holding pattern until customs either updates the ABI system to allow for those sorts of claims from the IEEPA tariffs, or something has to change elsewhere at the customs level or at the federal level in order to allow those claims to be processed. So this year, worse than any other year, yes, you're going to be out the cash until customs straightens out those things, and your broker can't do a damn thing about it, almost certainly. And I'm sorry for you. I hope that that gets fixed. Yeah, I've got no good advice here. Um, my understanding is that you should be eligible for those claims, but that may be something that has to be proved in court too. I'm not sure. I hope that's not the case, actually. Um, Roberto suggests doing certs entry by entry, never blankets. Certainly for claims, you would do entry by entry, but it's very common for suppliers or producers to issue certs covering their production of those goods for the course of a year. It really depends on the industry and what's going on there. Every business has their own different standards of how they limit the claims to be applied to a specific product. I always recommend doing it specifically by product number. And if there are other factors that might influence the eligibility down the road, like if you change your sourcing at the midpoint of the year, you produce new model years or whatever it might be, then change your product numbers to reflect that change in production processes, or attach some other limitations to it, or change the blanket period to be specific. It's often difficult to know the specific entry number for those certs, so you wouldn't usually provide an entry by entry. But brokers should obtain those and have those on file as needed. Alicia asks, is it improper to use a producer cert instead of an exporter cert for the import claim, or just not as common? It is not improper to use a producer cert. In a lot of cases, a producer cert is much more defensible than an exporter cert. It's just much more common for exporters to not want you to know who the producer is specifically because they don't want to cut themselves out of the transaction. So in most cases, exporters would produce their own certs for an exportation, and they would not reveal who the producer is. But yeah, if you can get the producer cert directly from the producer, use that for imports. That will work perfectly and in fact is often considered to be more authoritative than an exporter cert. Lena asks, for manufacturers certifying finished products for foreign importers, what type of documents are acceptable to obtain for raw materials and components that go into that production? Manufacturers certifying finished goods for foreign importers. Oh, so like a non-resident importer status. Okay. Um, if the goods are produced domestically and you're trying to certify on behalf of those importers, the typical documents that customs will ask for to verify the validity of a claim include financial records, proof of payment to suppliers, statements of origin from suppliers, statements of HS classifications from suppliers for that bill of material, for that cost of bill of material factor. And you would use that basis to demonstrate how the goods either met the tariff shift or the region of value content calculations. So you're looking at assembling your production's bill of materials using supplier information, goods that you've bought from suppliers that have country of origin and HS provided to you by the supplier, and costs as well that you can back up with financial records. So our bills of materials, when we do the FTA qualification for our clients, we will request a costed bill of materials that identifies all the suppliers, and then we will reach out to all the suppliers and ask them for originating status under USMCA, country of origin, and the HS classification that the supplier has. We will then evaluate the documentation that we receive back from the supplier, apply that to the bill of material analysis to make sure that we've got either enough originating content for region of value content classifications, or we've got enough tariff classifications in order to meet the tariff shift standards. So what kinds of documents we're looking for? Documents from the suppliers that affirm the HS classification, the country of origin, and the originating status of those goods. And we also use financial documents to corroborate that. Purchase orders, bank statements, a whole bunch of things can go into that. Monica asks, when determining USMCA qualification, can a producer use cost of U.S. labor in determining origin when all parts of the assembly being exported are of foreign origin? Yes. Typically, U.S. labor can be used in the calculation of, for RBC calculation purposes. You would look to the net cost or transaction value rules about what is an allowable cost. Direct labor costs are in there. There are limitations on the other factors typically. Usually, number one, you have to be able to prove your direct labor costs. And then if you're going to include other expenses like overhead costs or other ancillary production costs that are not part of the actual direct production of the good, certain things can be included, certain things cannot be included. So there is a fine-tooth comb. But yes, if you have a lot of labor costs here in the US, that can tip the scales to qualifying, even if all the components are foreign and you have an RBC rule that you're trying to meet. I'm still a bit confused. Anonymous asks, I'm still a bit confused by tariff shift. Would you have to classify the individual components based on what they currently are and what they would have originally been, or is it just a final good coming? Sorry, just a bit confused. Yeah, it's the the concept behind tariff shift is basically, are the components being transformed into a different enough finished good? So in order to know that, you would need the HS classification of the components. In addition, you would also want the originating status of the components. So when you're looking at your bill of materials and you've got all of your goods and all of their classifications and all of their status under USMCA, and then you look at your finished good with its HS classification, you want to know if the components are meeting the shift as they become that finished good. So if you have a component classified in Chapter 1 and you have a finished good classified in Chapter 87, it's going to meet that shift. It's going to transform sufficiently from an animal into a machine using those HS codes there. So yes, you definitely want to have that information from your supplier for your pretty much your whole bill of materials, so that you have a reasonable understanding what the HS classification is for your bill of materials and that you are ready to demonstrate that the goods have transformed to become the finished good that you're exporting. If the good that you're exporting is one of your components, then there is no transformation going on here. It is what it is. So there will be no HS classification change. I can do this easier with examples. So if you want to walk through a couple of examples, I can show you offline. So sorry about that. Tariff shift is confusing to understand for the first while. Chris asks, what if your good doesn't meet tariff shift but does meet regional value content? Is it eligible for USMCA? Only if the rule of origin for that HS classification for your finished good allows the use of regional value content. Some rules allow for either one. Sometimes you can use tariff shift, or if you don't meet the tariff shift, then you can use regional value content. You have to look up your HS classification rule of origin in those product specific rules to know if which rule you're supposed to apply and how. In some cases, you need to use a combination of tariff shift and regional value content, and those can be tricky, but you have to read the text probably 5 or 6 times to understand what the rule is asking for. You can only use what the rule allows for, though. So you cannot choose which one to use. There is a provision where certain things meeting a certain value content threshold, not meeting the shift, can qualify, but that's typically not the practice that most people should be using. Start with the rule of origin for your HS classification using Annex 4B. Anonymous asked, can you go over how this changes the process for clients looking to import personal vehicles from Canada? All right, vehicles are going to be their own special rules, and automotive rules of origin are much more complicated. Import requirements for automotive beyond USMCA are much more complicated. So I can't speak to importing personal vehicles from Canada, but I would say use the automotive annex in USMCA. There is I forget it's annex, I don't know, 4D. I can't remember exactly. That gives all the automotive rules, know what your good is, know which classification you have. There is a lot of text-based determinations where the definition of passenger vehicles versus definition of light truck and various other things are factored in there. But vehicles get very, very complicated. And if you do need a more detailed answer, definitely reach out to us after this, but that's where I would start. Melissa asks, did I miss where you mentioned USMCA will be up? Oh, I didn't talk about the renegotiation. For those of you that are still here, the agreement, I meant to put a slide for this and I totally forgot. USMCA was entered into force in July of 2020, I think. Yes. And the way the agreement is written, every 6 years, it comes up for renewal. So in July of 2026, US, Canada, and Mexico must agree in that point to either extend the certification period for another 16 years. So it would go to 2042, I think. And if they do not reach that agreement, then they would agree to meet again every year for the next 10 years. So USMCA is, I'm using air quotes here, it's in effect for 16 years from its date of signing. So we're right now, USMCA is slated to be effective and in place until 2036. Either after 6 years, they will agree to extend it for another 16 years from that point, or they will agree to meet every year until they agree to extend it for 16 more years. So if they don't reach agreement next year, the agreement says that it's still in effect for another 10 years after that point. They just have to meet every year to keep talking about it. That does not preclude one of the parties from leaving the agreement. That could definitely happen. So if, who knows on that part. But the agreement, the way the agreement's written is USMCA is in effect until 2036. If they do not agree to renew it by 2036, then the agreement will expire and it will be gone. But if they do agree to renew it before then it'll be in place for another 16 years, and then we'll have another 6-year wait before they meet to negotiate again. Sorry, Melissa, if I did not get to your answer while you were here. Hopefully you'll get it in the watch back. Daniel asks, in horticulture, is it in the rules of origin that plant materials need to be grown, such as a period of time in the US to turn into a US country of origin? HS sometimes won't change. Okay, so if we're saying that plants grown from other plants, typically that's a good question, Dan. Um, I I believe, and I don't quote me on this, but I believe if it's being grown here in the U.S., even though the source plant was from abroad, that product that was grown here in the U.S. is going to be origin criterion A and wholly of the U.S. at that point, as long as it's not the same uh, growth of that plant. But that's a really good question. I don't know the answer firmly. I think that's the way it works, but I would have to check it. So and if that's the Dan that I think it is, feel free to reach out afterwards, man. Good to see you. Manuel, how is U.S. Customs reviewing, auditing the validity of certs? What are their reviewing capacities? This is a great question. Um, their mechanisms for how they review is unknown. I know that data analysis and big data has entered into a lot of the analysis that Customs does, but I can't speak to what they're actually doing. What I can speak to is the manifestation of their auditing process and their reviewing process. What typically happens if Customs has a reason to ask for follow-up information, they will send a USMCA letter or questionnaire to the exporter or to the producer of the goods, asking a series of questions that proves that the goods are originating as presented to their customs administration. And that questionnaire is sort of the precursor to an audit. Uh, when you get one of those questionnaires, you have to be complete in your response because if you're not complete, the next step is that they would conduct a site visit, whether it's with CBP or whether a foreign customs authority comes in and CBP's in the room or they're coming directly, but they will come visit your facility, inspect your record, inspect your production process, and go through that is what is all, for all intents and purposes, a full-blown audit. And you don't want that to happen. The way I once heard it described to me by a former Mexico SAT customs official who was in the private sector giving lectures a few years back is Mexico will never come to the US unless they know that they're going to find something, and they won't stop until they do. So they're not going to waste their time coming up here to inspect a facility's process unless they already know there's something going to be wrong or they're very, very confident that they're going to find the thing that's wrong when they come up here. So that's that's kind of the shape of that. Jonathan asks, we got about 10 more, so for those of you that want to stick around. Jonathan asks, do you have any trainings on textiles in USMCA for items in Chapter 63? Jonathan, no, we don't have anything that is publicly available textile training. What we will do, if you want training for yourself or for your people in your organization, we will construct a training that is based around your products. We will talk to you, understand your products, and put together a program that helps you navigate applying USMCA in your production processes with your people, that sort of thing. We will teach them how to do it. But we don't have anything that's for public consumption. It can get quite complicated. And textiles in particular are just super special. Textiles and automotive are the two most nuanced, I would say. So if you do want a custom training, we will do that for you, but just reach out to us, train@startusa.org, if you want us to. Roberto mentions resolution particular, but very difficult to get. Oh, just a comment. Thank you very much. Manuel is saying, is it the case that after IEEPA, all of a sudden everything is declared USMCA coming from Mexico? That I don't know how true that is. I don't have access to actual stats coming from on all goods coming from Mexico, but anecdotally, it has been my experience that basically all U.S. importers have started to that U.S. importers that are importing from Mexico have increased their number of USMCA claims because previously the goods may have been duty-free coming into the US, but under the IEEPA tariffs, they're only duty-free if they're USMCA eligible. So goods that would previously come across the borders at no rate of duty, all of a sudden do have a rate of duty. MPF would still apply, but that's a relatively nominal amount. So the importance of USMCA skyrocketed once the IEEPA stuff came through. And I would expect companies to have responded in kind. Anonymous mentions or asks, will there be any course that goes over vehicle auto import specifically, or are there any previous courses available? No, Anonymous, I'm so sorry again. It's too nuanced. If you want to learn about specific audio, if this is related to that personal vehicle thing, it's kind of a one-off scenario. you might want to try reaching out to the CBP port or to the broker that's going to be filing the entry to get the direct guidance there. I can put together a training for you on some of these things, but brass tacks for a limited number of imports, the value is probably not going to be there for you. Um, it would be great to talk to the people that are going to take the most issue with that import, and that's going to be the people either filing the entry, that customs broker, or the port where those goods are going to be crossing. I know that crossing the border with vehicles, especially personal vehicles, uh, can be troublesome, and you definitely want to do your diligence ahead of time, prepare documents, have them in hand, especially if you're driving that car across. So, if you want to get more pointers, I'd be happy to try and find some information for you based on what you're trying to do. And if you do want a vehicle-based USMCA training session, I can put one together, and you can hire us for that. Roberto, speaking about Maquila's entry by entry, just in case a cert is not valid by CEP, they only rate advance one entry, not the whole year. So yeah, the Maquila program does add a lot of layers of nuance when importing into the Maquila or pulling out of the Maquila. Those entries are very, very common in the southern part of the U.S. And navigating those kind of takes a special understanding of the Maquila program and Mexico's SAT administration and the relationship with the U.S. company and who the brokers are on both sides of the border and how those pieces work. But yes, in those cases for Maquila-based entries, yeah, limiting the entry one at a time makes a lot more sense. I get what you're saying before. Dawn mentions we have a Mexico ruling that conflicts with the U.S. ruling on the same product. The goods qualify under each HS. What are the thoughts on two certificates for the same item? Dawn, you have struck gold. This is the scenario where you need to have different documentation depending on which country you're going into. Each country here, both Mexico and US, have decided what the correct answer is, and they are not in agreement. And therefore, that country is going to require a specific classification at the time of entry, and you must conform with that country's laws. And that means you have different certifications for the same product at different HS classifications. So I'm it's a pain to manage that variance by country. We've done it before on a Korea situation where Korea decided that all these goods are classified one way, and then the rest of the world decided that they're not. Um, and you kind of have to navigate it by hand and piecemeal as best you can. But yeah, you have different certs depending on which country you're dealing with. You may also have to pay attention to which classification you're going to be using for countries other than the US and Mexico, since you have conflicting agreements. So if you ever ship it elsewhere. So I'm sorry that you're in that situation, Don, and I can commiserate. Reto mentions with USMCA to import into the US, the importer can self-certify. Mexico does not allow that. Mexico does not allow the importer to self-certify. I don't think I knew that. I know the agreement says that you can, but maybe Mexico has carved out circumstances where maybe on paper you can, but in practice you can't. Or maybe it has to do with the Maquila program itself. That's an interesting bit of information there, Roberto. So the agreement allows for importers to make a USMCA certification. I categorically think it's a bad idea for most players, but in some situations it does make sense, particularly when you control the production in the foreign country and then bring it into the US, that kind of thing. Um, but Roberto is saying that in Mexico they do not allow that, so that's interesting. Anonymous has said that you covered the country of origin influence, but I want to make sure I'm understanding it correctly. For example, a product is manufactured in Canada, but due to specific origin rules, the country of origin of that manufactured product is the country of origin of one of its components, let's say the Netherlands in this case. The product goes through tariff shift in Canada, meeting the USMCA rules of origin for the commodities HS. No kidding. Even though the country of origin is Netherlands, would the product still qualify for USMCA since it undergoes tariff shift in Canada? Probably not. I believe the way the rule is written elsewhere, higher up than the product specific rule of origin, is that the goods must be of the member countries. And if the country of origin is not Canada, I don't know that you're going to get past that initial the goods must be of the member countries statement. I would be I've never dealt with that scenario directly, but I would assume that that would be initially rejected out of hand. You might be able to appeal that determination, depending on the circumstances, but probably not. If the goods are origin other than Canada, Mexico, US, then they're likely not going to qualify for USMCA, even if they meet that rule of origin. I would be surprised though, because in 19 CFR 10220, the rules of origin, the marking rules for NAFTA countries is the way they refer to them in 10220, are different than the rules of origin for um, substantial transformation for all other goods. Canada has a substantial manufacturer rule. So I'm not familiar enough with how Canada applies the nuances of the tariff shift and region of value content under USMCA to its country of origin determination process. I know the US has different rules of origin if the good is produced in Canada, Mexico, and US than the rules of origin that they would apply to any other country, even ignoring USMCA entirely. So there is a chance that it would qualify for USMCA, but then the country of origin wouldn't be Netherlands in that case. I would probably reach out to Canada Customs to see, or Canadian Customs broker. Um, um, okay, I think okay. Oh, and Roberto is adding more information about the maquilas um, on the per thing because there's abuse. Roberto, this is an interesting scenario. Feel free to kind of recap that for me in an email because I'm kind of reading a broken a chain here, but I'm very interested to learn what your experience is with dealing with USMCA for maquilas. I typically work from the issuing certs point to the maquila. I'd be curious what your experience looks like. Okay, everyone, we are way past time. It's 11:20. I have answered all the questions that I can see. Hopefully, I didn't miss your question, but if I did, please feel free to send an email. I appreciate everyone for sticking around, and I hope you had a good time. And if you need more clarification, just send us an email, and hopefully, we'll be able to answer it. It's been a busy year. Thanks all. Stop recording.